Welcome to the MUFG Global Markets Podcast. I'm your host, Ellen Tang, and I'm joined by Glenn Schultz, the head of Agency Mortgage Prepayment Modeling and Strategy for MUFG. Today is Wednesday, February 9th. And Glenn, thanks for joining us again this month on the show.
Hi, Ellen. It's my pleasure to be on the show, and thank you for having me.
So shall we start this off by talking about the January remit data and prepayment speeds? It was really the first time that the speeds demonstrated a significant decline on a month-over-month basis. So the first question I have for you is, was the decline in prepayment rates within expectations? And the second question is, what lessons have we learned over the last prepayment wave, if any?
Those are good questions. First, the January decline in prepayment speeds. That was largely in line with most forecasts. So the business day count declined 9.5% on a month-over-month basis. Seasonal factors declined, and the driving mortgage rates actually increased in our model about 45 basis points. So borrowers were a little bit more than 45 basis points more out of the money than they had been in the previous 2 months. So that's worth about 4.5 CPR in our model. So if you bring all of those things together in terms of higher mortgage rates, day count declines, seasonal factors, our forecast was right around 13.8 CPR. So all in all, we were about minus 0.8 slower CPR than the Fannie 30-year speeds. And then with respect to your second question, definitely we do have some strong takeaways in that the Agency MBS market, at least in my opinion, has experienced a regime change in the prepayment landscape.
So oftentimes I feel like when we hear the term regime change, a lot of people tend to dismiss that type of statement. So my question for you would be, how did you go about identifying a regime change in the prepayment landscape? And if this shift really has happened, what is the implication for investors here?
Yeah, sure. I tend to dismiss it's different now statements too, simply because economic time series tend to be very persistent, where economic structures tend to be very persistent, in this case, prepayment structures. And it's very difficult to fundamentally change an economic structure. So I understand the skepticism surrounding it's different now regime change. But really, identifying the regime change here in prepayments is based on the preponderance of the evidence, right? So first, in the most recent refi wave, we witnessed peak speeds, or what I like to call the terminal velocity, achieved just over a 55 CPR. And that was in new and moderately seasoned 2.5, 3, and 3.5 cohorts. So these are the cohorts that the originators were really, really super focused on, right? But this represents an all-time high prepayment speed print for Agency MBS. And in fact, this terminal velocity that was achieved by these cohorts actually rivals that of the non-agency jumbo space. And this is really the first time where we've seen Agency MBS in terms of in the money maximum prepayment speeds rival, sort of non-agency jumbo MBS. So I think that's actually quite amazing. And then second, we compared the most recent refi wave to the last refi wave. And so what we did is we compared S curves for each of those refi waves in which the prepayment rates reached terminal velocity. So for the most recent refi wave, that is 2020 Q1. And then the last or previous refi wave to this, that would be 2013 Q1. And so when we compared those S curves, what we observed was by seasoning, and that's new, moderate, seasoned, and across incentive groupings, the relative moneyness of the pools or loans. The recent refi wave S curves were all markedly steeper. The refinance inflection point had moved to the left. And those S curves, like I said before, were higher than those of the last refinance wave. So to put it in the jargon of just a few minutes ago, the terminal velocity of the most recent refi waves were substantially higher than the terminal velocity that was achieved in the refi wave previous to this or the last refi wave.
Thanks for that, Glenn. So do you believe that agency MBS market has become more negatively convex going forward than it had been in the past? And if so, what are the implications of this for the investors?
Yeah, I do believe so. I think it's largely attributable to originator investment in technology, which has allowed these originators to better solicit borrowers, reduce timelines from application to closing, and then in addition, we talked about this in November of 2021. Is the higher loan limits going forward, will act as force multiplier on this regime change. So as far as investors are concerned, I believe in that MBS investors will largely recognize this sort of like more negatively convex market ultimately, and demand a higher risk premium in the form of option costs, right? So in other words, recognition of the value of the short option that the lender or the investor has given to the borrower to refinance. So if that's the case, then either option adjusted spreads would decline, right, as option costs go up and nominal spreads remain the same, or nominal spreads versus benchmarks, must widen, in which case, maybe you end up with higher option costs and similar option adjusted spreads. So I think that's the dynamic that we should be watching sort of going forward this year. And then I think this concept of regime change or more negative convexity in the agency MBS market, I think raises the floor on specified pool pay-ups. So what I mean by that is, if before at the money sort of pay-ups across the loan balance sector were X, Y, and Z, now those numbers are going to be X, Y, and Z plus, plus a little bit more. So pay-ups, I think baseline at the money, that floor is going to move up somewhat.
So, Glenn, you talk about the idea of this regime change. We recently spoke about your 2022 outlook a couple of podcasts ago. So does this alter your view for this upcoming year?
No, at this point, no. We forecast spreads. This would be nominal spreads of the mortgage basis versus a 10-year current coupon to widen 25 to 30 basis points in that range. And at the time that we made that forecast, the basis was about 60 basis points. So we were forecasting current coupon basis in the range of 85 to 95 basis points. And at 95 basis points would really make the agency MBS market, sort of cheap on a historical basis, right? Now this idea of regime change, maybe it makes the 95 basis points or the high end of our forecast look more like fair value or maybe less cheap than it would otherwise be on a historical basis. So if anything, I think we probably end up to the wider end of our range as investors begin to price in greater negative convexity costs. And we've talked about this a couple of times. I've talked with our traders about it, and the question that they always pose is when is this going to show up, right? So their question is always like, okay, if this is the case, when does it show up? And, I think there's generally a consensus that we probably see this in the later part of the summer of this year will probably begin to manifest itself.
And so the 30-year mortgage rate has gone up quite a bit since you published your outlook. What about issuance? What do you think about that for this year?
Yeah, that's a tough question. I mean, we forecast more purchase origination to offset some of the decline in refinance activity. And of course, that trend obviously is going to be in place with higher mortgage rates. And I think so long as the 30-year mortgage rate stays sort of at or below 4%, purchase activity will continue forward along the lines, along the lines of our forecast. But, potentially slower speeds are going to reduce pay downs, due to prepayments. And that's going to, add back into our net issuance number. So at this point, I kind of think it's a push. We're still looking for issuance to fall in the middle of our $600 to $800 billion range. But as mortgage rates go up, I do think the range or the risk on that range could be growing to the downside.
Thanks, Glenn. Well, I think this podcast definitely shows there's a lot that MBS investors have to think about this year, and we're only 2 months into the new year. So with that, look forward to what we have to discuss for next month. And until then, thank you all for listening to the MUFG Global Markets podcast. You can rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And please reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research team.